Hello viewers, I welcome you on the lecture series of Corporate Accounting. Under today's lecture, we shall take up Unit 3rd, and under Unit 3rd, we are going to discuss in detail about valuation of goodwill. In our previous lecture, we have also learned a lot about the goodwill and its valuation. We have learned the meaning of goodwill and the need of valuation of goodwill, as well as significant factors which affect the valuation of goodwill. So, under today's lecture, our objective is to understand and analyze various factors affecting valuation of goodwill, as well as different methods employed to value goodwill, such as super profit method and annuity method. So, we will discuss in length about the factors which affect the valuation of goodwill first. In our previous lecture, we have learned the prime important factor which is necessary for valuation of goodwill, and that was known as expected future incomes. So, we have learned applying the simple average method as well as weighted average method, that how to find out the average adjusted profits which are necessary for the valuation of goodwill. Now, continuing our discussion on the factors affecting the value of the goodwill, we are going to discuss certain more factors which are normal profit, normal rate of return and capital employed. So, basically there are two factors which affect the valuation of goodwill. Firstly, expected future income, and second is normal profit. And in order to arrive at the normal profits, we need to take into consideration two more parameters which is known as normal return and capital employed. So, first of all, a question comes in the minds of the student that what do we mean by normal profit. So, let us understand first that what is normal profit. Normal profit is the rate of return which is just sufficient to induce an entrepreneur to remain in business. It is the aggregate of pure return and risk return. Aggregate means that both pure return and risk return forms the normal rate of return. Now, the normal rate of return in a layman language means the expected rate of return which an entrepreneur should earn from the business so that he can sustain himself in the industry and he can carry on the business as such. Now, let us understand these two parameters which are coming under normal rate of return, that is pure return and risk return, because we say that its aggregate is the normal rate of return. So, pure return means it is the rate of return from risk free investment. Now, risk free investment means that where there is a government securities or investment in government securities or bonds. So, we can say that rate of return on the risk free investments can be equivalent to the interest paid on the government securities. Like if there is a FDR which is with the nationalized bank, whatever interest rate they are paying to us is a pure return. Now, another parameter is risk return. So, let us understand what do we mean by risk return. To make an investment in a risky business, an entrepreneur expects a return, that is a risk premium, as compensation for the risk which is taken, and the expected risk premium is called risk return. That means where he is going above the pure return or the risk free investment, where he is investing in the volatile market, and whatever he is getting in return to take up such risk, such return is known as risk return, and it will be more than the pure return. So, when we consolidate pure return and risk return, it will give us the normal rate of return. So, we will learn it in an equation form, that normal rate of return is equal to pure risk plus risk return. Now, we will take up another formula to compute the normal rate of return, which is also known as yield. So, it will be computed as average rate of return into face value divided by market value. So, where information in the question is given in relation to the face value and market value, and the average rate of return is being given, we can go for this formula to ascertain normal rate of return. So, depending upon the information which is being given in the question, we can go for the calculation of normal rate of return. Now, there is an example with us by which we can understand that how to ascertain normal rate of return. An investor wants 5% additional return on the investment to cover the risk attached. If bank rate is 9%, calculate the normal expectation of the investor. So, here is our answer. The normal rate of return is equal to pure risk plus risk rate. So, pure risk is equal to the interest on the risk free investment, that is bank rate, it is 9%, and the additional risk which is being taken by the investor is 5%. So, 9% plus 5% will give us the normal rate of return to be 14%. So, this is the way normal rate of return is to be computed. Now, why do we need the normal rate of return? Because we need to find out the normal profit, because when we apply the normal rate of return on the capital employed or average capital employed, we can get the normal profit, and normal profit is one of the important parameters to ascertain the value of goodwill by applying certain methods onto it. Now, what is normal profit? That's our next question. So, normal profit is normal return, that is normal rate of return which we have calculated right now, multiplied by average capital employed. Now, a question comes in our mind is that what is average capital employed, or what is capital employed first? So, we can say that investment on capital employed refers to shareholders' fund employed in the business. Now, how it is being computed? It's very important calculation. So, first of all, we will take fixed assets, but it shall exclude goodwill, non-trade investment and fictitious assets. Fictitious assets are those assets which are not the genuine assets or which are being recorded in the list of the fixed assets, but in all they are not giving the returns to the business. Goodwill we all know, and non-trade investments are also the part of the assets, but in the list of fixed assets we will exclude all the three: goodwill, non-trade investment and fictitious assets. Then one thing is to be added into it, that is working capital, and we know that working capital is computed by the difference of current assets and current liability. So, current asset minus current liability is to be added to the fixed assets, and one more feature is there, that is we have to exclude or reduce long term borrowings. So, when we follow this method where fixed assets plus working capital is being added up and long term liabilities are being excluded, we can get the resultant as capital employed, and this capital employed is further useful to compute the normal profit. Alternatively, capital employed is calculated by another method. So, let us understand how we are going to analyze it. We will take up owner's fund less goodwill, non-trade investments and fictitious funds. So, at one end we are taking the fixed assets and working capitals and excluding the long term borrowings, and alternatively we can go towards the liability side where we are to find out the owner's fund, but again we have to separate or segregate the goodwill, non-trade investment and fictitious assets into the list of capital employed. So, both the methods can be taken. We can go towards the asset side and find out the investment or capital employed, or alternatively we can use the liability side to ascertain owner's fund excluding goodwill, non-trade investments and fictitious assets. So, by this we are able to understand that how to compute capital employed. Now, what figure we are going to use to compute the normal profit is the average capital employed. Let us understand how we are going to compute average capital employed, and what's the need of finding out average capital employed and why capital employed is not being used up. The reason is very simple. To make the figure of return on investment comparable with the maintainable profits which we have computed in step 1, and they are also known as average adjusted profits, normal return on average capital employed during the year should be considered. Further simplify it that when profits are being averaged up after adjusting the relevant datas or adjustments. Similarly, investments onto which or upon which ratio the normal profit is being computed, it should always be averaged up. Both numerator and denominator should be at a comparable level. That's why we are going for a average capital employed, and it is computed as opening capital plus closing capital divided by 2. Alternatively, what we can do is that 1/2 of the profit during the year is either subtracted from closing capital after the adjustments or added to the opening capital. Both way we can ascertain the average capital employed. So, we are taking up an example now. Under this example, there is a balance sheet of a proprietor having assets and liabilities. So, we need to ascertain the average capital employed and normal profit out of it. So, first of all, let us analyze what is being given on the liability side. Now, let us analyze the balance sheet of a proprietor being given to us. Here, first of all, we will move towards the liability side, where the information in relation to creditors of 30,000 and the capital of 6,45,000 is being given to us. They are aggregating to be rupees 6,75,000. Then on the asset side, the details about cash 5,000, bank 50,000, debtors 2,80,000, stock 50,000, plant 20,000, building 2,50,000, and fictitious assets are given as 20,000. Aggregating them, we are getting the total as 6,75,000. So, our assets and liability side are being matching up and they are being given in detail. Now, what other information the question is giving to us? The profit for the year 2000 and 2001 was rupees 2 lakh. The rate of return in similar business is 30%. This rate of return in similar business means normal rate of return. It is being given, that is already being computed taking into consideration pure risk and the risk return. The amount withdrawn by the proprietor during the year was 1,50,000. We are required to calculate the normal return on investment. Now, under this question, we are being given the information about profits and the withdrawals as well as the closing capital employed, but we are not with the information of opening balances. So, we can go for the alternative method to compute the capital employed or average capital employed. That means adjustment in relation to profits and drawings to be done to ascertain average capital employed. So, under first step, let us understand that how we are going to solve it. First of all, under working note, we will write normal return on investment, that is normal rate into average capital employed is the formula which is being used to compute normal return on investment. Then the normal rate is already being given in the question, that is 30%. Now, we are left with the task to ascertain average capital employed. Now, we have computed the capital employed at the end to be 6,25,000. Now, we will go with the alternative approach to ascertain the average capital employed, because information in relation to the profits and the drawings are being given to us, and as per the information given, we are suggested to go with the alternative approach to ascertain capital employed at the average rate. So, we will subtract half of the profit, and profit being given is 2 lakh and its half is 1 lakh. So, out of 6,25,000 we have reduced 1 lakh and we have added the half of the drawings. The drawings being given in the question as rupees 1,50,000 and its half is 75,000, which is being added up in the closing capital. So, ascertain. So, we are with the figure of average capital employed of rupees 6 lakh. We have done this subtraction and addition because in the closing capital profit would have been added. So, we have subtracted this profit and drawings would have been subtracted. So, we have added the profit so that we can ascertain the average capital employed. Now, as no information is given, it is assumed that profits made during the year and the amount withdrawn by the proprietor are evenly distributed throughout the year. That's why we are going for the half of the profit and half of the drawings. Therefore, half of the given amount has been adjusted. Now, the last step is the computation of normal profits, that is 30% of 6 lakh, because normal rate is 30% and average capital employed, which we have computed right now, is rupees 6 lakh. So, our normal profit figure is 1,80,000. So, we have learned in detail entire mechanism to compute the normal profit. Now, one question comes into our mind, that what is the requirement of normal profit for computation of goodwill, because we have said that it is one of the important factors to value the goodwill. Now, the requirement of normal profit is that we need to compute the super profits on the basis of normal profit, and super profit method is one of the important methods to compute the value of goodwill. So, as in when we move ahead, we are able to find out the various methods to be employed to value the goodwill, and under all such methods there is a requirement to compute either capital employed or the normal profits. So, these are the two important calculations which we have dealt right now and would be needing them in the further calculations as we move ahead to know the various methods which are to be used to compute the valuation of goodwill. Now, our next topic of discussion is the names of the methods to be known and understood which is to be employed to value the goodwill, and among it the important one are super profit method, scaling method, annuity method, capitalization of super profits, and average profit methods and capitalization of average profits method. So, these are the various methods which are being employed to value the goodwill. So, depending upon the need of the organization and the nature of the organization, we can go for either of the methods, and where it is the practice of the management to go for super profit methods, we will apply that method to value the goodwill as and when the triggering circumstances needs the valuation of goodwill. And under super profits method, we need to find out the normal profits and average profits and ascertain the super profits. So, there is a specific mechanism to go for the calculation of super profits method, whereby we will find out the value of goodwill. And under super profit method, again there are further classifications like purchase of years method, scaling method. So, as this method is elongated and long enough to be understood, we will deal with this method in a separate lecture. So, our next topic of discussion would be the valuation of goodwill under super profits method. Now, the next method is annuity method. So, what happens that annuity method is an improvement over the super profit methods and the sub methods of super profit method like number of years method, scaling method. Under annuity method, we are taking up the present value of the expected future profits. Then we are taking up the help of annuity tables and certain interest rates to be applied to these profits. Under annuity method, what happens that when we are comparing the present values of the future profits, a more precise or a better valuation of goodwill can be done, and we need to follow the specific procedure to go for the annuity methods. Then capitalization of the super profits means that we are capitalizing the profit, that is a formula being used as 100 divided by the normal rate into the average profits, and it can be used for the capitalization of the value of the business also. So, these methods we are going to learn one by one in detail in our upcoming lectures. Similarly, average profit methods can be taken into account to find out the value of goodwill. So, we will take up a practical example to learn how the average profits are being ascertained. What's the difference between the valuation to be done under super profits methods and average profit method. Now, in this part of the program, what we have learned, we will summarize it. In today's lecture, we have learned in detail about the factors which affect the valuation of goodwill. The first one was the expected future income. The calculation aspect of the same is being dealt previously. So today we have learned about the computation of normal profit, taking into consideration the computation of normal rate of return and average capital employed. Again, under normal rate of return, we have discussed that what do we mean by pure return and the risk return, how they are being aggregated up to a certain normal return. And we have also learned that normal profit is being computed when we multiply the normal rate of return with the average capital employed. Average capital employed can be ascertained either by using the formula opening plus closing capital divided by 2, or an alternative approach of making the adjustments in relation to the profit, that is half of the profits, to the closing capital or opening capital can be done. And we have also discussed in detail a practical example to analyze the various methods to be employed. In last, we have also discussed a practical example where we have learned to ascertain the normal profits, taking into consideration the formulas which we have learned in this lecture. And in a very short introduction, we have learned about the names of the various methods and their peculiar features to value the goodwill, such as super profits method, then various methods like scaling method, number of years method, annuity method and average methods, and capitalization of such super profits or average profits being ascertained to value the goodwill, or even the valuation of business can be done by capitalization of super profits. With this, we are ending up our lecture of today. Thank you.